The focus now turns to the Reserve Bank, which makes its next interest rate decision on Tuesday next week. And what's clear is that today's monthly inflation number certainly changed the mood on markets around future rate rises. Warren Hogan is an independent economist and an advisor to the small business lender Judo Bank and joins me now. Warren, thanks for your time as always. Let's go to this, sort of inflation number today. It did change the mood on the markets. It changed the outlook. The expectation of a rate rise next week from the Reserve Bank has gone way down again. So, again, it certainly changed things, didn't it?
The headline read falling from 6.8 to 5.6 is huge, and it makes it look like suddenly the inflation problem is disappearing, but it is an illusion. The underlying measures are all doing still over 6%. That is just volatility month to month.
Which is the reason why I pressed that with Michelle Marquardt and why we had her explain that to us. Because you take out fruit and vegetable, you take out, petrol prices, and you take out travel, and all of a sudden the inflation rate hasn't moved at all.
Yeah, well, the problem was previous month was probably too high and this month's probably too low. So the monthly movement looks dramatic. And, the markets overread it, as they tend to do. Looking at that trimmed mean, looking at the ex-volatile items, it's drifting off gradually. It's peaked. We can, safely say that. It's coming down very gradually. It's still at 6%. The inflation pulse in this economy as of Q2 is around 6%. And that's way too high. The good news, though, is because it's not getting worse, it probably gives the RBA a little bit of breathing space in the short term.
A little bit of breathing space, but it doesn't change the bias from raising rates in the future, I would imagine.
Not at all. In fact, I still think they're going to raise rates one more time before the governor's term finishes in September. I think you would want to leave the cash rate at around 4.35. This is completely consistent with it. I think it just means they don't have to go next month. They can wait and see what happens with the full quarterly release at the end of July. But even then, I don't think that's the full story, because we know right now that next week there's going to be a lot of price rises coming through. On the 1 July, the start of the new financial year, we're going to see insurance and postal services and everything you can imagine.
There's a whole bunch of things. There's childcare. There's tolls, road tolls. Transurban is indexed, so that'll go up. We just had a look. ASIC puts up its fees to companies. But there's a range of things that go up. So all of that becomes inflationary.
It does. And this is where it also, this concept of getting it entrenched. These are indexed to past high inflation, and it makes it sticky and hard to get this domestic inflation out. So the RBA's job is not done. The war on inflation rages. It just means that there's a quiet in the battlefront, you might say. I think the Reserve Bank will sit pat next week, just because we are going to see the full force of the last year of rate hikes play out in the economy right now over the second half of the year, whether it's the effects of the mortgage cliff or just the delayed effects of people realising they got more mortgage payments. And I think they're going to want to see how that goes before pushing up towards 5 or beyond. I think a 5% plus cash rate is a 2024 story, and it's not guaranteed. I mean, we all hope it doesn't happen, but we can't rule that out. And these numbers today in no way change that story. They don't tell us that inflation is rapidly going back to 3%. They tell us we've got some sticky high inflation in this economy still.
And a part of that is also wage rises, because the labour demand is still so hot, and you've got an unemployment rate down at 3.6%. That inevitably leads you to the conclusion. Plus, there's also the Fair Work decision, and that's flowing through to the enterprise bargaining agreements. All of that gives you the view that that's going to continue to add to the inflationary story.
The cost base for businesses and other organisations in Australia is still elevated, and wages are the key one. Energy is another one. Then, of course, all the other little bits and pieces that are in the CPI are actually some minor costs for businesses. But what I hear from business is everything's moving in the same direction, except for in the manufacturing sector. That's now starting to see some easing of those inflation pressures. But in the services side of the economy, and this economy is 85% services, manufacturing is less than 10, all of the costs are going one way at the moment.
So very, very quickly, they basically pause this month, but there's at least one more rate rise in this cycle to come.
I think there's at least one more before September, and then I think we're hopefully going to pause right through to summer.
There you go. I've got to tell you, always good to chat to you, Warren. We will see, and we'll certainly chat with you next week as the Reserve Bank makes that decision. Warren Hogan there.